Hello, and welcome to Seminar 6 of AC 2401, Accounting Information Systems at Nanyang Business School of Nanyang Technological University in Singapore. In this session, we shall be covering the first part of the revenue cycle in an ERP environment. In this seminar, students need to provide an update as to how far their teams have progressed with a course project, review some points in the previous seminars, do a quiz to refresh, review, and cement your understanding of key concepts, and then move on to the revenue cycle. For the course project, please email me the name of the organization that you are engaging with, details of the contact person, and evidence of your communication in the form of an actual photograph of your team together with the contact person against a backdrop containing the entity's logo or other acceptable evidence. Here are some slides that provide a reminder of the due dates and other relevant requirements for the project. We have studied business processes, how one can redesign or re-engineer these for greater effectiveness, better efficiency, and improved adaptability to the changing environment. We have learned how we can depict business processes and transactions by way of flowcharts, and how to improve weaknesses in internal controls. We have commenced our immersion in the SAP ERP system and gone through key aspects in financial accounting in SAP or the FI module. This is a snapshot of the module. We have completed the sections on business process, flowcharting, process efficiency and control issues, and financial accounting in SAP. In later seminars, we shall be covering other aspects like the expenditure cycle, the controlling module, and analytics. Process redesign requires one not to just improve matters incrementally and gradually, but rather to look at the entire process, overhaul it, and take it apart and reformat and reconfigure processes if necessary. This flowchart is an example of a situation involving various departments in an organization and includes most of the symbols that we can use in depicting transaction processes and information flows. Control is important for an organization so that it can achieve its objectives, safeguard its assets, and provide accurate and reliable information about its operations. Fraud can take two forms. One is misappropriation of assets like cash, merchandise, and even data, and this also includes employee fraud. The other one is fraudulent financial reporting, or cooking the books, as the layman might call it. An ERP system contains several components or modules like financial management, manufacturing, human resources, and customer relationship management. The focus of our module is SAP. Now let's review financial accounting in SAP. We have defined the chart of accounts, which is essentially a listing of accounts in the general ledger that provides the structure for financial reporting. There are three types of charts of accounts, namely the operative, country, and group COA. Each one of these has its own purpose or role. This is how the mapping of accounts from the operative COA to the country and group COAs for jurisdictional accounting filings and group reporting purposes respectively occurs. In SAP, the group COA is mapped by assigning the group account number in the COA segment, while the country COA is mapped via the alternative account number in the company code segment. SAP has strong data control features. It does not allow deletion of data unless these are backed up or archived, and keeps track of data creation, changes, movements, and deletions. This is a sample of a record showing data change information. SAP has three levels of security comprising the user master record, transaction code, and authorization checks. SAP allows the setting of limits on transactions by way of size and the responsibility and role of the individual by way of tolerance groups and thresholds. This is how SAP defines tolerance groups. ERP systems like SAP keep track of the flow of information and data via an audit trail to enable enhanced control. User authorizations are another important control feature in SAP. A transaction can be traced all the way from the top-level report or display through processing all the way through to the source document or originating transaction, as depicted in this figure. Next, a short quiz to test your understanding of the concepts learnt in the previous seminar. Questions will be displayed, followed shortly by the suggested answers. You should attempt to answer the questions on your own, and you may pause the video as necessary. Question 1. Which of these are FI organization data in SAP? The options are company code, sales area, business area, chart of accounts. You may pause the video at this point, and this applies to the other quiz questions, and resume once you've answered the question at your own time. The answer is company code, business area. Organizational data represent the structure of the entity, and these include client, company code, and business area in FI. Question 2. Which of these is an FI master data? The options: document types, general ledger accounts, posting keys, financial statement versions. The answer is general ledger accounts. Master data represent entities or items associated with the enterprise, and this includes customer, supplier GL account, and inventory or material master data. Question 3. How many COA segment records does each GL account have? The options: 1 per COA, 1 per company code, 1 per country, 1 per business area. And the answer is 1 per COA, as shown in this figure. Question 4. Which COA contains GL accounts used for posting accounting transactions? The options: Group COA, Country COA, Operative COA, Reporting COA. The answer is Operative COA. The Operative COA is used for recording and reporting purposes, whereas the Group COA is for group reporting and the Country COA is for country or jurisdiction-specific reporting. Question 5. When posting an accounting document, which organization unit is mandatory and must be specified? The options: client, company code, business area, GL account. The answer is company code. The company code must always be specified for a journal entry or accounting document. Question 6. Which of the following fields is stored in the header of an accounting document? The options: GL account posted, amount posted, posting key, posting date. The answer is posting date. As can be seen in this screenshot of a display document window, the document date is shown in the header. Question 7. You can generate financial statements for a selected blank. The options: company code, country, business area, division. The answer is company code, business area. Question 8. What is the effect of reversing a posted accounting document? The options: the document is physically deleted, the document becomes parked, new items are added to the document, a new document is posted. And the answer is, a new document is posted. Question 9. Which of the following statements about controls in SAP is false? The options: tolerance group limits the size of transactions a user can process. All documents must be parked first before posting. Once posted, accounting documents cannot be changed. Changes to master data and transaction are locked by the system. The answer is, all documents must be parked first before posting, and once posted, accounting documents cannot be changed. It is not compulsory for a document to be parked first in SAP. In fact, you could immediately post a document if you want to. Once posted, however, only certain non-critical fields in accounting documents can be changed. Alternatively, you could reverse the accounting document. Question 10. Which of the following data are not part of the audit trail for accounting postings? The options: accounting documents, accounting document items, account balances, trial balance. The answer is trial balance. The trial balance is the final tally of GL accounts that shows the debit or credit balances in each of these, and it is not part of the audit trail. This figure shows you the accounting documents, the accounting document items, and the account balances, and these provide the audit trail. We have come to the end of the quiz, and we shall now discuss the Seminar 5 questions, and these questions provide scenarios of problematic situations. You should read the discussion questions and attempt to explain how SAP features can solve the problems identified in each of the 3 scenarios. You may pause the video to do so if you have not already done it. The suggested solutions will be displayed next. Question 1A is about Company A having different financial reporting requirements for legal, internal, head office, and tax purposes. Extracting and reorganizing the information to meet these differing requirements consumes a lot of resources, especially when requirements change. So how can SAP help? Well, you could define different financial statement versions or FSV for different reporting layouts. The accounts in the company's COA can be assigned to reporting lines such that the system would group and aggregate the account balances and generate the relevant financial statement format to meet the specific reporting requirement. Question 1B is about Company B, whose accountant has discovered some errors in accounting documents. The first error is in the header text field. The second error is a posting to an erroneous account. So how can we rectify these errors in SAP? The first error in the header text field can be changed even after posting, as it is a non-critical field. The second error cannot be so amended. To correct this error, either a reversal entry should be posted followed by the correct entry, or one could post another accounting document to transfer the amount from the erroneous account to the correct one. Question 1C is about Company C that has expanded to become a parent company with more than 50 subsidiaries operating in various jurisdictions. These subsidiaries are using the exact same SAP ERP system, but with different COAs. Consequently, the group accountant faces difficulties in performing monthly consolidation. In this case, all subsidiaries should use the same operative COA to the extent possible. However, this may be challenging in practice. Alternatively, a group COA can be set up with accounts mapped from the subsidiary COAs. Financial statements of the subsidiaries can then be generated using the group COA for submission to the group accountant for easy consolidation. The revenue cycle part 1 will continue in the next video.